Hello, everyone. Good morning, good afternoon, or good evening, depending where you are in the world. Thank you so much for joining us today. We are super excited. You are watching a webinar about pricing and scoping for digital agencies brought to you by Visita, a company that works closely with digital agencies, helping them maintain positive ROI, boost those revenues, and create amazing engagements with small business customers. We have a special guest with us today, Marcel Padepa. Marcel, how you doing?
I'm doing great. Thanks for having me.
Thank you so much for joining. You recently returned from a nice trip and vacation, so we're honored to have you with us so shortly after your vacation. I hope it was fun.
It was, yes. I was in San Diego, which is, probably the perfect place in North America to be. So had a good time.
Okay, well, I can just say that I am not jealous at all. Wink, wink. I wish I was on vacation recently. I recently moved houses, which is probably the opposite of being on vacation, but here we are today and we're at the webinar. I see more and more people joining us. So hi, everyone. Thank you so much for being here with us today. We are super excited. We have lots of great content stocked up for you today. We're here to talk about pricing and scoping for digital agencies, and Marcel is the man to be talking about this topic because he is an expert on agency profits, and he's going to be sharing many insights about how to get that pricing strategy right, how to balance things like costs and risk, and how to create a winner strategy for 2023, which is, oh my God, just around the corner. So we're going to kick it off just before we kind of clear the stage for Marcel. I'm just going to let you know that today is going to be an interactive webinar, and we would absolutely love for this to be an open conversation. So if you have a question or a comment about something we're saying or something you see on screen, just please feel free to drop us a note in the Q&A panel or in the chat. I'm going to be monitoring those closely and making sure that we answer all your questions. Some of them we might address kind of during the conversation, some of them we might address at the end. So don't you worry, you will get an answer for any question. Give us a high five or a hi or a good morning in the chat, just so we can know that you're there in the US. See, there's a quick instruction of how to activate the Q&A panel. If this is your first time using GoToWebinar, you might want to take a quick look just so you understand how to engage with us during today's presentation. So we're going to actually kick it off with a quick question for you guys about your current challenges with pricing. So you're going to see that poll pop up on your screen just about now. And we would love for you guys to tell us, what is the main challenge you normally face when it comes to defining your pricing strategy? Do you usually kind of worry about things like putting a price tag on non-tangible services, which is something that many agencies offer their customers? Are you concerned about staying competitive, maybe not being outpriced by your competitions, not having your prices too high so other agencies are able to steal customers from you, covering operational costs, which can become quite high, and maintaining that positive ROI, and maybe it's something else completely. And please feel free to tell us what that something else is in the chat. So a lot of people are talking about covering operational costs, which honestly doesn't surprise me at all. Marcel, is this coming as a surprise to you?
No, not at all. This is we're going to go deep on this today.
Fantastic. So I do see that more and more people are filling out the question, but it seems to me like almost 50% of you guys are talking about covering operational costs as your main challenge when it comes to defining a pricing strategy. So hopefully you'll get some great tips and answers from Marcel here today. Marcel, do you want to tell us a little bit more about you and what you do in today's presentation?
Yeah, well, as you mentioned, my name is Marcel, and I'll use my slides here to help explain a little bit more about what it is that I do. So I'm the CEO of a company called Parakeeto, and what we do at Parakeeto is help digital agencies measure and improve their profitability. So this is basically our entire focus as a company, and we help through consulting and technology. So we help digital agencies install and design a system that helps them measure their most important metrics, and then we can actually become their fractional data team and help them run that reporting system and help them learn how to interpret and act on that data and improve their business. I'm also the host of the Agency Profit Podcast, where you'll never guess what we talk about, agency profitability. So if you enjoy today's presentation, I encourage you to go check that out, where you can continue to consume this kind of nerdery on an ongoing basis. And I get to apply this knowledge in two really great organizations, the first being Goldfront, which is a category design agency out of San Francisco that works with really cool brands like Uber, Nike, Adobe, Slack, and actually a lot of really exciting Israeli startups that are doing some very cool stuff and creating new categories, as well as SaaS Academy, which is the #1 B2B SaaS coaching program in the world. And really there I focus on the services side of software as a service. So this is what I do. I eat, sleep, and breathe agency profitability. And my goal today is to just demystify what is, I think, one of the most overwhelming and confusing areas of agency operations, which is pricing and scoping, and what is the difference between those things, and how do we cover our costs, get to the right price, and ensure that we're going to be profitable from the very start of a project when we give a price to a client.
All right, so I see more and more people are joining us. So hi everyone, welcome. Just in case you missed our brief introduction, you're watching Pricing and Scoping for Digital Agencies, a webinar about winning the pricing game for 2023, brought to you by Visita, the company that works closely with digital agencies to help them engage clients and boost revenues. And we are gonna hand the microphone over to Marcel. If you have any questions for Marcel, please feel free to drop us a note in the question or in the chat at any point throughout the presentation. So Marcel, the floor is yours.
Thank you very much, Rachel. So welcome everyone, thanks for being here. And as I mentioned earlier, today is going to be all about helping demystify, I think, one of the most misunderstood areas and most overwhelming areas of agency operations, which is figuring out how to price projects and do so in a way that sets us up for success. So put a yes in the chat if you've ever struggled with answering questions like, what is the right pricing model for my agency's services? Should we bill based on time? Should we do value-based pricing, flat fees? Should we do retainers? Should we do some other weird thing? If that's a question that you've struggled with, let me know in the chat. Or maybe you've struggled with understanding how profitable should a project be when we price it? And how do I figure out exactly what my costs are and what should be included in that and what shouldn't be included? Should I include overhead? Should I not include overhead? How do I figure out the right price point? How do I figure out the right profit margin? And how do we even calculate that profit margin to begin with? If you've ever struggled with these questions as well, again, let me know in the chat. I want to make sure that we're focused on the right things today. If those are things that you maybe don't have complete clarity on, then that is what we're going to be discussing today. You might not have a clear vision or strategy when it comes to pricing your projects. You might not have very good systems or data or tools built out to help you and your team do this. If you're doing this at scale, it might mean that you have to empower a sales team with the ability to make these judgment calls on their own. And you might also just basically be guessing and stressing when you make important decisions about taking on clients and projects and what you're going to charge for those things that have a collateral impact on your entire team and of course on your pocketbook. So my promise for today is I'm going to give you some clear benchmarks and metrics that you can use to figure out if your agency's projects are profitable or not. I'm going to help give you some frameworks so that you can create repeatable outcomes and make sure that you're doing this the right way every time. And of course, create alignment and predictability so that even if your team ends up being the one that's scoping and pricing projects, you can give them these principles and allow them to make the right judgment calls. So with that, we're going to start with the high level, which is how does an agency make money in the first place? And I know this is going to seem kind of rudimentary, but it's an important starting point because everything that we talk about in terms of profitability and pricing is based on this after the fact. So we'll go through a simple example here. The first and most important thing that an agency should be measuring is their AGI, which stands for Agency Gross Income. So I'm going to write that in here, Agency Gross Income. And what is agency gross income? Well, it's the amount of revenue that your business collects that actually belongs to you as an agency. So if you're an agency that does a lot of media buying, perhaps you're buying print, perhaps you're outsourcing some of your work to white label partners for production, website design development, something of that nature, then you want to be able to strip that cost out of your revenue so that you can see the amount of revenue that's actually your responsibility to earn with your internal resources. And this is really important because we don't want to make spending decisions and we don't want to be measuring our profitability based off of total revenue. We really want to be paying attention to the revenue that is actually our agency's responsibility to earn. So stripping out that pass-through revenue is really important. And that gets us to agency gross income. So assuming that you can measure that, the next thing you need to be able to measure is your delivery cost. And your delivery cost is essentially a measure of what it costs you to earn your revenue, or what the cost is to get things done for clients. And most of the time, this is going to be the internal labor cost that's required to get work done for clients. So the salaried employees and the amount of time that they contribute to getting work done for clients, or in some cases, freelancers, if that's part of the core business model that you use to service clients where you have elastic resources to get things done. And then sometimes there's also going to be shared delivery costs in here as well. That generally will be tools for enabling your delivery team. So good examples of this would be like Adobe Creative Cloud or stock footage library, or maybe software that you use to run ads on behalf of your clients. And those kinds of things might be included here as a delivery cost because they're not just for one client, but your delivery team needs those tools to do the job. So you need to be able to isolate your delivery cost. And most agencies, we look at a lot of financial statements for agencies as part of our consulting service. Almost none of them can actually see this without doing some math. And the reason for that is all their payroll in their profit and loss statement tends to just be in a single account, and they're not splitting it out to isolate the amount of payroll that's dedicated to the delivery function in the business. And the same thing is generally true about tools and software. So make sure that when you leave here today, you go and check your financial statements and sit down with your bookkeeper and make sure that you're able to isolate this, because it's a very important thing to measure. And it's what all of the rest of the calculation we're going to talk about is based on, is the gap between AGI and delivery margin. The next thing that we want to pay attention to, of course, is overhead, right? What does it cost us to run the business? And that's going to be stuff that you would expect, like accounting, legal, facilities, the internet connection that you have to have for your business, maybe some of your salary or salary that you have for people like sales or admin assistants, things of that nature, right? There's a certain cost to just running the business and keeping a working environment around your team. And so you want to, of course, be isolating and measuring those expenses as well. And what's left over after you pull those things out is your profit. So to run through a practical example, if I run an agency that does $1 million in AGI, 1 million, and I have $400,000 in delivery costs, then what I have here is a delivery profit of 600K, right? So I have a margin on my services of $600,000 or 60%. That's pretty good. And then in this example, if I also now spend another $300,000 on overhead, then I'm left with, in this case, $300,000 in profit, which is about 30%. And 30% is a pretty good net profit. And by the way, 60% is a pretty good delivery profit. So this is about 30%. So when we think about agency profitability, I think one of the common mistakes that we have when we think about pricing and we think about measuring profitability is we're trying to figure out net profit on a project or on a client or in a department. And it's kind of a flawed concept when you really start to think about it, because your overhead is not going to fluctuate at the same rate that your delivery margin is. You're not going to hire or fire your bookkeeper because you lost one client. If you lose 10% of your revenue, you generally can't cut all of your overhead relatively by 10%. And so you want to isolate and measure these things separately. And what that allows you to do is understand what is contracting. If you see your bottom line shifting, what's causing that? Is it an imbalance in the overhead costs that you're spending relative to your agency gross income? Or is it that the fundamental profitability of your services is shifting around? And when we start talking about pricing, we want to really be focused on this number, the delivery costs, and really optimize for the right delivery profit margin. So what this brings us into now is the difference between pricing and scoping. So if we look at the formula for delivery margin, which we looked at above, which is essentially AGI minus delivery cost over AGI, you see that there are two essential components. And sorry, I'll shift over here. You'll see that there are two essential components to that formula. The first is AGI, which is basically asking the question of how much are we being paid for the work? And pricing is really that exercise of asking the question, what will the client pay, right? What will they pay? And conversely, we have a separate question, which is what will it cost us to do this for the client, right? And that's the exercise of scoping, is asking what will it cost? Sorry, I got to talk in right at the same time. What will it cost us? And so you can see that these are two related but completely separate questions. And one of the first mistakes that we see agencies make when they start to price and scope their projects is they use a single document to do the pricing and the scoping. And often it's the same document that they put in front of the client that's also being used internally to capture the estimations and the assumptions that they have about the project. And that's probably the first thing that if that's happening in your agency, you want to immediately correct. Scoping is a separate exercise from pricing. They're related, but they should happen in separate documents. One you do for yourself, not for the client. That is the scoping exercise. And the important thing to do here is to be completely honest about what it's going to take to get something done for the client. And then the second exercise is a pricing exercise of then establishing how much the client will pay for that work. And then we want to reference those things relative to one another and make sure that there is enough margin in that project once we have isolated those two variables. And more often than not, what we see is agencies will start by asking the client, what will you pay? And then the client tells them what they will pay and what they want the scope to be. And then they back into the scope. They start pretending that it will take this amount of time and they make the scope fit into the price, even though the reality is they know that it's going to take more time to do that. And that doesn't benefit anyone. The same outcome can be generated where the client pays that price, but at least we have clarity internally that we are expecting it to take more time than usual. We're going to have a lower margin. All of that still ends up being true. The only difference is we were honest and clear about it and could plan for it and expected it, as opposed to lying to ourselves at the onset and then wondering why we're not profitable on the back end. So separate these two concepts and really focus on delivery margin. So again, the formula for delivery margin is our AGI minus our delivery cost divided by AGI. And so we need to be clear, how much agency gross income will we be making from this project if a client pays a certain price, and what will it cost us to earn this revenue? So as an example, if I have $1 million project and it's going to cost me $400,000 in delivery costs, then my delivery margin on this is going to be 60%. What should the target be for delivery margin, you might ask? Well, generally, what we want to be achieving on the profit and loss statement is a 70%, or what we want to achieve on the profit and loss statement, sorry, is a 50% delivery margin. So if I scroll down here, so what we want to have on the P&L is 50% or more. And the reason for that is because most agencies will spend between 20 and 30% of their agency gross income on overhead. So if you want to be netting out at 20% EBITDA or higher, then you probably need a starting point of 50% or higher to give yourself a chance at achieving that. But the way that we establish our target on the profit and loss statement is by looking at what net profit do I want to achieve, understanding how much you'll likely spend on overhead. Generally, the rule of thumb is about 30% of your agency gross income will go to overhead. That should include your salary as a founder. And then you add those two things together, and that will give you your delivery margin target for the profit and loss statement. So what this means is that on a per project basis, you generally want to be anywhere from 10 to 20% higher than your profit and loss statement target. Why is that? Well, it's because some projects are not going to go as planned. You might go over budget. Your profit margin will be lower. You will not be utilized 100% of the time. You might have periods in your business where there isn't enough work to keep the team busy. And so you're paying the delivery cost for that team, even though you're not earning revenue at a relative rate. So you want to bake some risk into your project by project profitability. And so what this means is that on a project basis, if my target was 50%, on the profit and loss statement, I would want to be pricing services to give me at least a 60 to 70% delivery margin. So the question I get asked often at this juncture, which is a really important thing to consider, is what falls into delivery cost, specifically in the case of a project. And this is going to be after stripping out pass-through expenses, the remaining delivery cost to get that done for the client. So generally that's going to be the time from your team. If they're salaried, you're going to look at their cost per hour and multiply that by the number of hours that they work. If you're using freelancers, of course, it's going to be what you're paying that freelancer, whether it's a flat rate or the amount of hours that they work and the rate that they're being billed out at. So adding those two things up, you get to this equation. And this is essentially what you want to check before putting a price in front of a client. And if your delivery margin is going to be under 60% or under 70%, that's fine. Just be honest with yourself that that's what you're setting yourself up for. So at the end of a project, when you do a retro, you're not surprised. So I want to check with everybody that's watching here. Is this making sense? Let me know in the chat if you're following so far, because the next thing we want to talk about now is what are the different ways in which we can establish the price and start to wrap our arms around engagements where maybe the scope is not so clear.
Hey Marcel, so I'm checking the chat and it looks to me like everyone is saying that this has been super insightful and clear so far, and they're really looking forward to the rest of the presentation.
All right, well, we're going to jump into my favorite part of this whole framework, which is the agency pricing quadrant. So if you've ever asked yourself the question, should I be pricing this based on flat rates? Should I be doing value-based pricing? Should I be using time materials pricing? Then this is the framework that you're going to want to pay attention to, because this is exactly how we facilitate this conversation with our clients when we do consulting engagements. So there's two primary things that we want to consider when determining what the right pricing model is for a particular service. And the first thing is value, which is going to go on this vertical axis here. So we have high value services and we have low value services. So let's define this for a moment. What do I mean when I say high value or low value? Well, I mean, what is the value or the perception of value from your client's perspective? So a high value service, for example, would be something where the client perceives this as being extremely valuable to them. And so there's two things that generally will influence that. The first is positioning, and the second is the relative value to the client. So when I talk about positioning, essentially what we're asking is, what is the amount of alternative solutions that somebody could compare you to? And so if I was selling graphic design services as an example, and my positioning was, we are a graphic design agency, I'm putting myself automatically in the low value area. The reason for that is because there are so many other agencies and so many other services that position themselves as graphic design. I'm competing against everything from Canva to Fiverr to IDEO and some of the greatest creative firms on the planet. There are hundreds of thousands of options that a client could now start to compare us to, because that's the box that we've drawn that we put ourselves in. And it doesn't matter if we're substantially better than all of these other options. We haven't given the clients the right positioning framing on why we're different. And so they are now allowed to compare us to all these other options. And whether they're right or not, they're going to perceive us as being the same as these other firms unless we give them a clear point of differentiation. So by contrast, if I'm selling to a B2B SaaS company that has these complex systems that they sell to customers, and my positioning is now, we help B2B SaaS companies visually communicate complex data systems using design. I might still be doing the exact same service, graphic design, but my positioning has now drawn a much smaller box, and there are going to be far fewer firms that put a stake in the ground and say, this is our area of expertise, and therefore they will perceive the situation as being one where they have fewer options to choose from, because they can no longer compare you to every other graphic design firm on the planet. So positioning is the first really key driver of value. And then the second key driver is relative value. So a good example here would be if I sell website conversion rate optimization services, and I have two clients that are looking to purchase from me. One of them does $10,000 a month in sales on their website. The other one does $1 million a month in sales on their website. If I can get both of those clients the same result, which is a 1% improvement in their conversion rate, who is that going to be worth more money to? Well, clearly the agent or the business in this question that does $1 million a month in revenue, they're going to get much more value from that 1% incremental increase. And so we want to consider the scale, the particular context, perhaps the vertical that our client is in, and how much upside there is in them purchasing our solution or getting the outcome that we can deliver because of their context. And not everyone is going to be willing to pay the same amount of money for a service because it will not create the same amount of value to them. So that's the first thing to consider when we're selling services is, how is this being perceived by my client in terms of the value that it generates for them? And it has absolutely nothing to do with how much time it takes you, how good you think it is, how valuable you think it is. None of that is relevant. The only thing that matters is what your client believes the value of this service is. And your job in the sale is to establish that, understand what's important to them, and then build anchoring and positioning so you can elevate your value in the sale. Now, what I will say is that there's also nothing wrong with selling low value services. That's a legitimate business strategy, but we'll talk in a moment about what needs to be true in order for you to succeed at that. So that's value. If that's resonating, let me know in the chat, put a yes in there. And we'll talk about the second piece of this axis, which is risk. And so we have two varying types of risk. We have low risk services. We have high risk services. And what do I mean by risk? Well, essentially what I'm talking about with risk is how easy is it for me to estimate the amount of cost that I will incur in order to deliver this to the client. So if I can consistently get to within 10% of the estimated cost, then that is going to be a fairly low risk type of work. So an example of this would be, I have a productized service. I sell one-page websites to legal firms. I build them on the same website builder every single time. Maybe I'm using an outsourced vendor, a white label partner, or I have a software that helps me automate the workflow. And that really allows me to very predictably deliver this deliverable to a client with very little variation in the amount of time or cost that I incur to do so. That would be a very low risk type of work. I know how long it's going to take me and I know what it's going to cost me. So that's a very different posture than if we're doing high risk work, where it's very, very hard to estimate the work for whatever reason that might be. Maybe we've never done it before. Maybe the nature of the work is high risk. So custom software development tends to be this way, or solving very nuanced, complex strategic problems for clients might require us to just spend a lot of time in an exploration mode. Or perhaps the way in which we have to operate in order to solve this problem is inherently iterative. So agile software development is a perfect example where the whole purpose of that agile methodology is to do a sprint, learn as we do the sprint, and then adjust the strategy based on what we learn. So it's impossible up front to estimate how long it's going to take, because the process we need to engage in order to solve that problem is going to be iterative, and therefore the scope will change the more we learn about this particular issue. So those would be examples of high risk work where it's hard to estimate, or it's just impossible to estimate because of the nature of the work. So now that we've established the different axes, what do we do in each of these situations? And let's start in the bottom left-hand corner. So we have high risk work that is low value. Typically here, this is a good place to use time materials billing, also known as hourly billing. And I know that there's a war on hourly billing right now that seems to be happening in our industry. Everybody seems to think that it's evil and you're way behind the times if you're billing on time materials. But if you really think about this, what better way to share risk with the client than by billing by the hour? Because if the contract is structured in this way, and we know that the risk in the engagement is high, it could take 100 hours, it could take 1,000 hours, it could take 100,000 hours, then if we're being paid by the hour, it doesn't matter how much time it takes. Our job is then to make sure that we establish that expectation with the client, we manage the scope, we manage priority. But if we do this right and we focus on really good account management practices and we get paid for the time that we work, then it doesn't matter if the scope changes. So we absorb the fact that this is high risk work, and we use that to protect ourselves in a time and materials billing structure. And the reason that we would focus on hourly wages here is typically when we have low value work and we're able to get very low cost resources to do this work. And remember, if we go back to the equation earlier, the only thing that matters in the pricing equation, no matter which of these solutions that you choose, is that we target that anywhere from 60 to 70% margin. So if you sell an hour, in this case for $100, then as long as your cost for that hour is under $40, you're making money. As long as you get paid for every hour that you work and you keep that cost low. So this is the game with time materials billing, is making sure that you protect your margins, you set your pricing to reflect the margin that you want. And typically when we're selling low value services, we can focus on the hourly rate if we have low cost resources, and that becomes a competitive advantage and the client feels like they're getting value because we're focused on time and materials. Now, let's move up the ladder. Let's imagine that we're selling high risk work, but now the value is high. Maybe we're building a custom website for an enterprise company that does millions of dollars in revenue, and we're having to solve some very complex technical challenges. The risk is still very high here, so we don't know how long it's going to take, but we do have some value that we can arbitrage here in the sales conversation. So what we would typically use here is something that we call abstracted time and materials. And what we're doing with abstracted time and materials is instead of selling an hourly unit, we're just selling larger units of time. So we might sell a 2-week sprint. We might sell a team for a month. And we're abstracting away from the hourly conversation, which typically allows us to increase the rate or the margin that we're applying to our cost basis. And we're using that strategy because we have value to arbitrage. So an example of this would be for this enterprise client, I might say, hey, we're going to lease you this cross-functional expert website development team. It's got 2 full-time developers, a full-time designer, a quarter of a strategist, and a solutions architect. And that team is going to work with you to build this website. And based on the scope that you've given us today, we think this could take anywhere from 20 to 30 sprints, and it's going to be priced at $20,000 per sprint. And now that relationship is anchored to sprints. So if they ask for more features, if the scope changes throughout the project, no problem. We just add more sprints. But we're also able to price this in a way where we're not talking about hours, we're talking about a larger unit of time, which typically allows us to increase that price point. So that's abstracted time materials. Let's flip over to the other side of the equation where we're doing low risk work. So this is stuff that's really easy to predict how long it's going to take, and we have low risk to arbitrage. In the case that we're doing low value type of work, this is typically where flat fees work very, very well. And the reason for that is because we are going to take the risk on, which creates certainty for the client and often can create the perception of value. So I'll give you an example of this. If you came to me and said, Marcel, I need a website for my business, how much is that going to cost me? And I said it's $500 an hour. You might tell me to go pound sand. $500 an hour is too much. And you'd probably be right. It sounds ridiculous to pay $500 an hour for website design development when I have lots of other alternatives. However, if I told you, no problem, the website is going to cost $5,000 and we're going to get it to you in 2 weeks, it's going to be blazing fast, SEO optimized, converts for your industry, all that stuff, just $5,000, you might say, well, that's a great deal. I might still make $500 an hour on that website, but it doesn't matter to you because I've given you certainty with the flat price. And the reason I make $500 per hour is because I know that I have an efficient process here that I can use to get this done, and it might only take me 10 hours to earn $5,000. In that case, I make my $500 per hour, but I've used a flat fee to leverage that situation, give you certainty, and combat the low value nature of the work. Finally, we move up to this section here, the high value, low risk situation. This is typically where we start to look at value-based pricing, which I'm sure you've all heard about. It's a very hot topic, and it is a very advanced and very powerful way of pricing in the right context. And value-based pricing is really where we start to anchor the price to the value that's being created for the client. So in the earlier example, I talked about, what if we increase the conversion rate for an agency or an e-commerce business that does $1 million a month in revenue? Well, if we increase that by 1% a month, what's 1% of $1 million? Well, it's $100,000. Or sorry, it's $10,000. And so that's going to equate to $120,000 over the course of the year. So we might start to say, okay, well, are you willing to invest 20 or 30% of that upside in order to get it? And do you think it's reasonable that we can increase your conversion rate by 10% or by 20%? So by understanding the value that we create for that business, we can start to create a higher price point that's not at all connected to how long it takes us, because again, we know how long it's going to take us. And what we start to do is try to push that price up by anchoring it to the very high value that it has for the client and away from the cost that it has for us. But the reason that we put this over here in the low risk area is because if we don't know how long it's going to take us, then we're taking on a lot of risk, and we need to price a lot of risk into the deal if the work starts to move towards this side of the quadrant. And the other thing about value-based pricing is there's an even more advanced version of it, which is results-based, right? So an example of this would be saying, hey, you're only going to pay us for the leads that we generate, or you're only going to pay us for the additional sales that you make on this particular service that we're going to give to you. And that requires us to move even further down the low risk side of the spectrum, where we not only know how much time it's going to take us, but we also know how predictable that result is going to be for the client. So this typically requires a very high degree of maturity in our service offering, with having both data that helps us understand how long it takes to do these things, as well as data that helps us understand with what degree of certainty can we produce this outcome for clients. So typically a very advanced thing that takes a while to get to. We need to do a lot of at-bats at a service before we get to a place where we can really afford to take that level of risk on and have it be consistently profitable. So with that, the last thing I'll say is that as you go through your journey as an agency, it's natural for service offerings that might start in one area to, over time, gravitate up and to the right for two reasons. Number one, you'll generally, as you do more and more of a service, you'll develop better process, better systems, and you'll collect more data on how long it takes you to do things. So the risk should decrease over time in most service offerings that are not innately risky in terms of methodology. And your positioning and your portfolio should get stronger, and therefore you can slowly start to increase the perception of value that you create for clients as your portfolio gets stronger and your business gets more mature. So understand that this quadrant and using it to understand the right pricing model for each of your services is not a static exercise. It's something that is going to shift over time and can be used as a continual tool to assess when the right time is to start evolving your pricing models or adapting them to capture more of the profit that is available to you as the business transforms and matures and you start to get better at delivering the services that you offer to your clients. So with that, we're just gonna go straight to Q&A, and I'll turn it back to Rachel with some closing notes. We'll open things up.
Marcel, thank you so much. That was super insightful. And I don't know about you guys, but I actually took a screenshot of that last slide once you had all the information in it, because I think it's also a great reminder about how in many ways pricing is fluid, and you kind of have to move your pricing strategy with you and with the confidence you have in your team as they become, kind of more efficient, and as they have their efficient processes nailed down, and as you're able to minimize that risk, and have a better understanding of estimating the type of work and the cost. Speaking of estimation, I do see there's a question here about, what do I do if I just find it really difficult to estimate the actual cost or actual investment in time that a project may take, and how should I still be able to give like a pretty good estimation of price if I'm not really sure what the cost would be on my agency?
Yeah, so this is where I think we want to really think about this left-hand side of the quadrant, right? So this is high risk work. And so really what you want to try and do is have this conversation with the client and really understand, why is it that you can't wrap your arms around the estimate? Is it because the client's not able to give you clear requirements? They're not really sure what they want. They're not able to give you that kind of an information, in which case you could say, look, unless I have answers to these questions, or unless we can agree and lock these things in, I can't lock in a price point because I'm not sure how long it's going to take. So, either you give me this information, or we can work together to uncover this. And once we get it, then we can try to move over to a flat rate, or we can work together in an iterative fashion. And that will be kind of your justification for anchoring things to either time materials or abstracted time materials. The other big idea here is understanding that when you price based on time, what you're selling is units of time, and then you're using those units of time to fill up scope. And so if that is agreed upon and understood between you and the client, then the scope changing doesn't really matter, because you just add or remove units of time to fill that up. The inverse is what's happening when you go to flat-based fees. What you're trying to do is establish the scope, and you're selling a certain amount of time up front, and then you hope that the scope contracts or expands and stays within those boundaries. But as you know, sometimes that's not the case. The scope expands outside of the boundaries of what you had originally expected, and then there's a conversation that you have to open up with the client about, hey, can you give us more money for this? Which of course is generally not a very fun conversation to have. So this is why I think it's critically important for you as a salesperson to understand, okay, what are we anchoring our price to? And then your account manager should also be very clear about this, because the battle is not won and lost on the sale. It continues throughout the entire engagement, and there has to be a different account management kind of conversation. But understand that you don't have to actually scope the project necessarily up front if you're leveraging an abstracted time materials or a time and materials type of engagement. Of course, a client might push you for an estimate and you can give them an estimate, but give yourself some grace by giving them a range and explaining that that range will become more clear as you get further into the project and learn things, or as they can more clearly define the requirements to you.
Absolutely. I think
Good question.
it's a really important point about just kind of having these open conversations with clients about pricing. You know, I know that sometimes it can become quite awkward, especially if you're in a position where it wasn't spot on and you're kind of finding it, you know, kind of running towards the bottom of that ROI graph and feeling that there's so much that's being invested. I do think that there's an that I hear many agents speak about where very often the cost of acquisition for a client can become quite high. And
Hmm.
that's sort of also something you're always bearing in mind, where you're sort of starting in a position where you're in the minus because you've paid so much to get this customer, whatever, you know, through whatever funnel they might have come through. And then you kind of have to work that in to the way you're calculating the actual ROI, just bringing the customer on board and then actually making profits off the sold service. How would you recommend tackling that challenge, Marcel?
Yeah, and this kind of rolls up to the larger question of like when, because of course the answer to all of these challenges will just ask the client for more money, but sometimes there's a legitimate constraint where you're afraid now it's like, okay, well the client said their budget was this, the scope is this other thing, so we really theoretically need to ask for more money. But what if we lose the client? And there isn't always a direct, what you have to understand in order to make a call on whether or not to discount a project in the moment or whether or not to absorb that sunk cost from having acquired the client is really forecasting your utilization rate. So this is something we haven't talked about in this presentation, but if you want to learn more about it, you can check out the Agency Profit Toolkit, where we have some more training videos and resources for you to learn about the other important metrics in agency profitability. But utilization rate is essentially looking at, okay, we have paid for a certain amount of capacity. When you have salaried employees in your agency, you're buying inventory, and the agreement, to be really, really frank about it, is like, I'm buying 2,080 hours of your life as an employee, and I'm going to try to resell as many hours as those that time as possible at a profit. But I'm going to prepay you for those hours at a guaranteed rate. That gives you certainty as an employee. So that's what you get. You get benefits and all that nice stuff. And then as the agency owner, I need to make a profit on those hours. Otherwise, I shouldn't be employing you. That's not a very good business model. So if you buy a whole bunch of hours next month and there's already lots of work to fill those up, and you know your utilization rate is going to be high, that's a situation where you probably want to avoid discounting. Or if you have lots of other deals in the pipeline and you know you're going to be able to fill up your capacity next month, you probably don't want to discount the project, because what happens in that case is you might sell a deal where your average billable rate ends up being $100 per hour, but you could have sold another deal at $160 per hour. So you lost $60 an hour by selling the cheaper deal, because you don't have any more time. You can't just go create more time to do that other work. You had to choose between one or the other. Whereas if you're looking at next month and you're like, our utilization is going to be like 10%, we really need this work, then selling an hour for $1 is better than selling it for nothing at all. So in that case, there's, you know, almost no limit to how much you want to discount a project, as long as you know, you're able to sell that hour for anything at all, really. Then you're better off than having that hour go bad at the end of every day, which is what happens. Your inventory essentially spoils and you end up selling it for $0. The other alternative that most of us are trying to avoid is you have to lay off part of your staff. But assuming that you're trying to avoid that, or you have a certain degree of certainty that you'll be able to catch up and get their utilization up, and you're just trying to bridge a gap, then discounting in that situation makes sense. But I think what's dangerous is focusing on trying to close every deal at all costs in every context, because of that kind of sunk cost fallacy of, well, look at what we spent to earn that customer. Because probably what ended up happening is you didn't deploy all that money just to get that one customer. You probably have a budget every month that goes into your sales and marketing budget that you spend. You get the leads that you get. So that cost is not really truly connected to that one client. It's more of a global thing that you would be thinking about in the context of your overhead. Right up here, sales and marketing would fall under overhead, and it's generally going to be reasonably consistent. So don't get too wrapped up in customer acquisition cost. Instead, pay attention to your utilization and use that forecast to help yourself understand, is this a time when it makes sense for us to discount, or should we be holding our ground and asking for what we need? Because if this client doesn't bite, the next one is very likely to at the rate that we need to charge to make a good profit. Hopefully that makes sense.
Yeah, I think that's a really good way to put it, how you kind of have to look at the cost of acquisition as part of overhead and not necessarily on the individual client level. And then that kind of eliminates some of that chase for the seeing ROI as something you should be measuring on the individual client level. And even more so, something I speak to we at Visita, we work with a lot of digital agencies, and we very often have conversations about pricing and packaging of services. And something that I hear a lot of agencies talk about is also kind of creating service bundles as a tactic to combat high cost of customer acquisition, where you'll bring a client in, who just wants the website or just wants the, whatever review management, reputation management, and introduce them to a whole suite of services which they might not be aware of, or, kind of might be buying elsewhere, and get them to kind of just sort of just increase deal volume and just generate better recurring revenue per client, which is, we know that studies show that acquiring a new customer is, I can't remember if it's like 4 or 5 times more expensive than retaining and upselling an existing customer. So just making more of your existing customer base is something we hear many agencies speak about, especially in in today's financial climate where spending is becoming, kind of, people are being a little bit more conservative, especially small businesses becoming a bit conservative with their marketing spend. So just kind of being able to nurture those existing customers, creating additional revenue opportunities for your agency from within your customer base. I think that's a conversation we have with a lot of digital agencies nowadays. And that's something that we really kind of try to help agencies do at Visita. Visita is a platform that works with many digital marketing agencies and other enterprises from other verticals. Basically, anyone that serves a small business community can use the Visita platform to launch their own digital solution for small businesses. So we have a business management platform that is sort of, it has an open nature to it. So a lot of our partners will kind of take our platform, add any additional services to it, like website building, PPC management, review management, and serve the entire toolbox to their clients. This is something we see many agencies do, and it kind of helps them also increase retention because our solution is co-branded or white labeled, so the agency brand just sort of gets featured everywhere. And it's also something that creates stickiness because you're really giving your client the solution that they're using for their daily activities, like collecting payments, booking appointments with their clients, answering messages, getting alerts when new leads convert on their website. And we work with many digital marketing agencies and find that we're able to really help them increase customer loyalty and boost their revenues. I mentioned bundling before, and that's super relevant for many of our partners, since many of them will actually bundle the subscription to Visita with other services like a website, which is kind of a very organic way of doing things, because what they'll do is they'll kind of use Visita to deliver their customers leads. So if you're an agency and you work with small businesses, you can have a CRM, which you give each small business, and you can actually deliver the leads that are generated from your website into your client CRM, or what we call an action-ready environment. So they get notified about that lead immediately and immediately take action, like send a message, invite to a meeting, send a price quote, or basically any other action, and they can do this directly from their mobile phone. So if that's something that sounds interesting to you, we would absolutely love to be in touch. You can go to visita.com and read more about our product and more about our partner offering. You can also just drop us a note here in the comments. Let us know if you'd like to have a conversation about how we can help your agency increase profitability and kind of create great long-lasting relationships with your customers. I want to thank you so much, Marcel, for being here with us today. You guys have been a great audience. Thank you so much for sending in your questions. I do see that Lucy is asking if this webinar has been recorded. So the answer is yes, absolutely. The webinar is being recorded, and you can definitely expect it in your inbox probably tomorrow. I do see one last questions
Mm,
for Marcel, and maybe we'll take this one just before we wrap up. Marcel,
sure.
what is the most profitable client you work with doing?
So it's interesting. This is going to be pretty relevant to VCTA actually, but you've explained one of those things, which is focusing on expansion. But really, there's three things that the most profitable clients we've ever audited are doing. And actually, there's one agency in particular that we audited that was by far the most profitable that we've ever looked at. And the thing that they did that I thought was really interesting was they basically didn't do any of the work. They sold projects to clients. They had a niche, right? They sold to one specific vertical, which was personal injury lawyers, and they sold them SEO services. And they did the account management, they did the sales, and then all of the other work went to white label outsourced partners. And what that allowed them to do, if we think about this practically, is it allowed them to lock in their delivery cost. They agreed to a flat rate, whereas we sell this package to the client, and it costs us $5,000 to hire you to do this every single month. And then they would sell that to the client at, because they had this very specific niche and they were experts in that field, they would double, sometimes triple the price that they were being charged by the white label vendor. And then if you think about their variable delivery cost, it was really just the amount of account management time, communicating with the client, managing the projects, delivering the deliverables to the client. Every now and again, they might had to, go in and fix a mistake on the website or something like that, but they had a very, very lean internal team, and their margin on AGI was almost 50%. So almost half of every dollar that came into the business ended up in the owner's bank account. It was insane. So I love this idea of essentially thinking about, we have a core service. One thing that we're really good at, sometimes that's strategy, it's client relationship management, it might be selling to the client. And then how can we find other people who are experts or other resources that we can sell to the client that doesn't really create any additional work for us? And so selling software products, payment processing, right? These kind of software white label solutions is one amazing tactic where we can dramatically expand the relationship that we have with the client, to your point, without really adding any delivery costs to the equation. So what we're doing in this situation is we're maybe very incrementally increasing delivery costs, but we're increasing AGI without really adding any additional overhead, and increasing the delta between what a client pays us and how much time it takes us to do that work is the entire game when we think about agency profitability. And the thing I love about using white label type services is it allows us to offer a lot of services without increasing the operational overhead of running the business. So we don't have to hire a bunch of additional staff, which means we don't need more complex HR systems and more complex, bookkeeping and accounting practices. And we don't need to add all this additional drag and people management burden. We just need reliable partners, and they take on most of that complexity. And that's a beautiful thing, adding additional revenue without increasing costs. And what this might also allow you to do, if you kind of think about this, is you might have a service right now that's high risk because maybe project management and scoping and all this kind of stuff, it's not really your bag. You're just good at selling stuff, you're great at strategy, maybe you have great creative ideas, but when it comes to being organized and keeping your team on task, that's not your thing. And we've had a few clients that had that realization, realized that their strength was really kind of that higher leverage, higher value stuff, and they pushed the delivery towards a partner. And what that essentially is doing is it's pushing you from high risk to low risk on your service offering by locking in that cost or making it more predictable. And then you're able to really start driving your price up or creating a stronger wedge between your price and your cost. Because historically, if you're not a great operator, then your work is high risk, and that can be the reason that you find yourself struggling with profitability, or you find yourself really stressed out in your agency. So I think acknowledging your strengths as an operator and really leaning into that, and then being comfortable with pushing some of your revenue outside the four walls and retaining a smaller percentage of it, but having that percentage of revenue that you retain be substantially more profitable is the game. And the quote that I'll leave you with on this is, most agencies are suffering from indigestion, not starvation. They just happen to feel the same. And so as you sit and look at your profit and loss statement and think, man, it's great, like how have we doubled our team size and yet I'm still making the same amount of money? It's probably an indigestion problem, not a starvation problem. So think about how you can remove complexity from your business, decrease risk, and just focus on the thing that you're best at. So hopefully that's insightful.
First of all, I love that quote. Thank you so much for including that in your presentation. Guys, this has been fantastic. I want to thank you so much for tuning in. You're watching Pricing and Scoping for Digital Agencies, brought to you by Visita, the platform that helps agencies create additional revenue sources and fantastic engagement with their small business customers. Thank you again, Marcel, for being here with us today. Guys, I highly recommend you follow Marcel on LinkedIn. I personally have connected with him a few weeks ago, and I have been blown away by the fantastic content that he shares there quite regularly. So thank you so much for that, Marcel. And I do want to encourage you again to check out visita.com if you're interested in partnering with us or learning more about our product and our value proposition to digital agencies like yourselves. Just before you go, we would love to collect some feedback on today's presentation and hear a little bit more about what type of topics you would find interesting for future webinars. I see someone else is asking about the recording. So yes, absolutely. Session has been recorded and we will definitely share that recording with you. You can expect it in your inbox probably tomorrow. So I am going to be launching that last poll question. If you have another minute to stay with us, just please let us know what you thought about today's webinar. We'd love to hear your thoughts and feedback just so we can kind of plan ahead and continue creating great content with fantastic guests like Marcel. So just take a moment to answer the poll question on screen now. How would you rate today's webinar? Just let us know, give us your feedback, help us improve for the future. I see so many of you are saying that it was fantastic, which makes me super happy. Thank you so much. So please take another moment just to fill out the question. And before you go, I do have one last question for you about additional topics you might find interesting. So if we were to do another webinar in the coming weeks, which we'll probably will do, which of the following topics would be most interesting to you? Are you interested in learning more about marketing during the current financial climate? Are you interested about increasing customer engagement and loyalty? Are you interested in serving the ever-changing needs of small businesses? Or are you more interested in boosting agency revenues? So just take another moment to answer that last question. Help us continue creating content that is interesting and relevant to digital agencies like yourselves. And I'll leave you with that, guys. Thank you so much again, and thank you so much to Marcel. I want to wish you guys good luck with tweaking and kind of creating these winner pricing strategies for 2023. I think, we have a lot to look forward to. We have all the reasons to be positive about this coming year. I really hope it's a fantastic year for all of you. I know it's a little bit early to be wishing everyone a great year, but I'm going to go ahead and do it anyway. Thank you so much again for joining, and we will see you next time. Take care.